Hello, everyone. Welcome to another session of Revise as Pro. In this session, we are going to discuss the Section A, Part 2, that is financial statement analysis. And from that, we will cover the important aspect of financial ratios. This particular section has a weightage of 20%. So, definitely, it is important for the examination. And also, if you are very much clear about the concept, it is also high scoring in the exam. We already had a session earlier on financial statement analysis where we had covered the aspects of comparative financial statement analysis, which includes our horizontal analysis and also the vertical analysis. But here today we are going to revise the financial ratios. So let's get started, everyone. And I think this would be really helpful in the final stages of your revision. So moving ahead, in terms of what we are going to discuss today, the financial ratio analysis in terms of the aspect of what can be asked in the examination, because that is something that we are all should be focused on, is that our MCQs may involve the different types of financial ratios which are broadly classified as liquidity, solvency, activity and profitability ratios. And here we will have calculations, interpretation, as well as analysis. Now, if the interpretation analysis forms part of MCQ, that would be generally very small portion, but interpretation analysis generally forms a part of our essay questions, which would be the bigger questions, right? So in essay questions, we'll have the various ratios can be asked to compute to undertake a comparative analysis and responding to the reasons for the change or trends that has been identified. So we'll go through an example in this particular session that will help us to understand the calculation, interpretation, as well as analysis part separately. But here, first of all, what are the important points that we should remember from the financial ratio analysis? The first thing, in terms of understanding a ratio, ratios always measure a comparative relationship between different components of a single FS or between components on different financial statements. So this is very important, what has been highlighted on bold. The ratios can be relating to different components of a single financial statement, like out of our income statement or balance sheet or the cash flow statement, or there can be the relationship between the different components of one financial statement, which might balance sheet, and another maybe income statement. Why I am focusing on this particular line, that might be helpful when you are given a essay question to explain what is a ratio analysis, and you can quote this particular line to explain that. Coming to the next point is that why we need the ratio analysis. It helps us to analyze the past, present, and the future performance, as well as the financial standings of an entity. So this is about the usefulness. Next, the third bullet is very important. Ratio expresses the relationship between the numerator and denominator of the components involved. And the numerator components or a component have a direct relationship. That is, if there is an increase in the component of the numerator, it will have a positive impact on our ratio. But if that in case of a denominator, there is an inverse relationship, which means that if the components in a denominator increases, the ratio will undergo a decrease and vice versa. Why I'm stressing on this particular point, this is very important for you when you are analyzing or interpreting ratios. If you understand the relationship between the ratio and the numerator and denominator impact, it becomes much easier to answer. Next point is that when the ratio analysis questions are given, and if you are not provided with any numbers in the question, please don't calculate mentally, because you might apparently feel that okay, this has increased so the ratio will increase, this has decreased so the ratio will decrease. But generally in the exam stress, it is always wise to use hypothetical numbers and calculate the increase or decrease in the ratio and conclude accordingly. So don't try to do it mentally, because it may go wrong. Because sometimes what happens is that the percentage of increase and decrease in numerator and denominator may impact the ratio differently. So it's very important that you use hypothetical numbers to determine the increase or decrease and then conclude accordingly. Finally, many questions come from the students: how do I remember so many ratios? The easy way out is three things you have to do. You have to revise periodically so that the things remain fresh in your mind. You have to write, as it is often said that if you write few things, it is 10 times reading. So it's better to write the formulas, which generally is difficult. The easier ones, the ones you know comes naturally, you may not write those, but those which generally needs to be written because those are somewhere a bit complex, it's better to do so. And also practicing the mock questions while answering those. If you write the formulas, that becomes easier to remember. So I think these are the important points that we should keep in mind. Moving ahead, the next thing is that in the financial ratio analysis, as we have said, that there may be different type of ratios, broadly classified as the liquidity ratios, or there can be the profitability ratios, solvency ratios, and activity ratios. But today in our session, we'll cover with two important ratios, the liquidity and solvency, and we'll try to apply the concepts of calculation, analysis, as well as interpretation, so that we can leverage that learning to the other different types of ratios. So firstly, talking about liquidity ratio, it actually measures the ability of the company to pay short-term obligations, which is generally less than 1 year or 1 year, and meet any unexpected need for cash with its current assets. And current liabilities represents the short-term obligation. So here the focus is whether the company is able to meet its short-term obligations in a smooth manner or not. What is the position of its current assets so that it can be readily convertible into cash and the obligations can be met. So the liquidity ratios main focus area is that higher the liquidity ratio, better it is generally for the company to meet its short-term obligations. Because if my current asset position is strong, naturally it will be better for us. So higher the ratio, better is the liquidity. That is how we interpret it. Now, current assets includes my cash as well as other assets which are expected to be convertible into cash within 1 year, or company's operating cycle, whichever is longer. Similarly, current liabilities are short-term obligations which are expected to be paid within 1 year, or the operating cycle, whichever is longer. Now, liquidity also includes the other concepts like the conversion of the inventory into sales, credit sales to AR, and finally to cash, and payments which are made for the accounts payable and other liabilities. When we talk about operating cycle, what it is a time from the receipt of inventory to sale on account, and finally receipt of cash from customer. That means from the time we are receiving the goods in the inventory to that of the sale to the customer, assuming the credit sale, and finally collection from the customer, the entire period is my operating cycle. Now the question is that what are the different ratios that we need to keep in mind from the liquidity ratio standpoint, right? So again, we should focus around calculation, interpretation, as well as analysis. The important ratios, first is a net working capital ratio. How do we calculate it? Net working capital divided by total assets. And net working capital is current assets minus current liability expressed as a percentage. So what is the amount of my net working capital to my total assets? This is being measured by this particular ratio. Current ratio, current assets by current liabilities, known to most of us from our early days. It is expressed as a dollar and cents in current assets for every dollar in current liability. And the ideal ratio is 2:1, which means that my current assets should be twice that of my current liability. That is the ideal ratio. Quick ratio or acid test ratio, this is a bit stringent version of the liquidity ratio than the current ratio, because here if you see, we are taking as a numerator cash plus the marketable securities plus accounts receivable, and we are ignoring inventory and prepared expenses. The denominator remains the same, current liability. Ideal ratio is 1:1. Coming to the cash ratio, it is the strictest version of the liquidity ratio because it's the toughest measure of liquidity, as we are only considering cash and marketable securities, MS, measured in the numerator, divided by current liability. And it is again expressed as a dollar and cents to the current liability. Finally, cash flow ratio, and how we compute it, it is cash provided from operations. That is a cash flow statement. We know that cash flow operations is one of the significant components. So cash provided from operations divided by the current liability. It is expressed as a percentage. And what it measures is measures how efficiently the cash provided from operation covers my current liabilities. So what has been received from the cash flow operations, whether it is sufficient to cover my current liabilities or not, that is a measure of this ratio. So all these ratios measure our liquidity. A quick question can be that in case you have been asked a question that what is the liquidity position of the company? Is it good, bad? And you compute only the current ratio and you see the current ratio is showing a desirable ratio, and to conclude, that's not the right way. Remember, you should not just focus on a single ratio to determine the position of a company, whether it is in aspect of liquidity, profitability, solvency, whatever it is. You need to calculate 2-3 ratios which actually for which information is available, and see what is the trend. Are all these ratios showing the direction in the same path? Are they going in the same way? Then only you will be able to conclude that okay, all these ratios are indicating in the same direction. Then we can conclude whether the liquidity, the solvency, whatever it is strong or it is weak. So remember this point, don't judge on the basis of a single ratio computation. So that's all about the liquidity ratio that you should keep in mind. Moving ahead to the next one, which is our solvency ratio. Now, in liquidity, we focused on short-term obligations. Solvency goes a bit farther extended. What it measures? It measures the company's ability to survive for a long period of time, measures the financial health, and meet not only the current liabilities but also the long-term liabilities as and when they become due. So this is basically the ratios which is measuring the financial health of an organization, whether the organization will be able to meet not only the short-term obligations but also the long-term obligations. That is the factors of the consideration for this type of ratio. Solvency ratios computation uses components from income statement, balance sheet, and cash flow statement. What does it mean? The numerator and denominator can have components from each of these financial statements. Ratios to remember, again, three aspects: calculation, interpretation, analysis. What are the different types of solvency ratios? Debt to equity. That is, what is the total portion of our company finance which is being represented by debt vis-a-vis the equity. So total debt by equity. And debt here means total debt, total liabilities. And equity is my shareholders' equity or total equity. So when we speak of debt to equity, another point should be kept in mind is a measure of our financial leverage and risks. So if our debt to equity, that is if our debt component is very high, then it generally shows a situation that is amplifying the return for the shareholders, but there is a high degree of risks involved for the entity because it may not be able to meet the obligations when they mature. They may not be able to meet the payments of the liabilities when it becomes due. So it becomes a very highly risky venture. It's an aggressive nature of the business that gets projected. Similarly, when a debt to equity is basically showing a lower ratio, it means that the organization is following a conservative approach. So that's the important point should be kept in mind from an interpretation standpoint. Long-term debt to equity similar to the first, but here we are only taking in the numerator long-term debt. We are not taking the short-term debt here, and the denominator remains the same, equity. And when how to calculate a long-term debt? Total debt minus the current liabilities. Debt to total assets. This is again what is the portion of my total assets which has been financed by the debt. So total debt by total assets expressed as a percentage. So how much of my total assets is financed by creditors? That is being shown by this particular ratio. So generally what happens is that if the debt is high, the ratios will have a tendency to show high, which shows a risky situation for the organization. That is a point that we should keep in mind. Coming to the next point is that fixed charges coverage ratio, or it is also known as the earnings to fixed charges ratio. How do we calculate it? Earnings before our fixed charges and taxes divided by the fixed charges. And fixed charges shall include our interest payments and principal repayments of loans and leases. Another variant is the interest coverage ratio, that is also known as times interest earned ratio, where the formula is EBIT divided by the interest expense, and EBIT means earnings before interest and tax. So both these two ratios are generally expressed as the number of times my earnings is covering these fixed charges or interest payments. So higher the ratio, the better it is, because it shows the coverage of my fixed charges or the interest payments by the earnings. So these two ratios are very important from an exam standpoint. Generally MCQs are asked from these two ratios. Finally, coming to the cash flow to fixed charges, how it is done? It is basically cash flow from operations, net of tax, remember, then the fixed charges plus the tax payments divided by the fixed charges. We are adding back the tax payments because we are presuming, or here we are considering the cash flow operations is net of tax. What does it measures? It measures whether the company has enough cash to pay off the fixed charges and not from earnings. So this is going to be a more stringent measure of solvency because here we are taking into consideration the real cash which is received from the core operations of the business and whether it is sufficient to meet our fixed charges or not, and we are not considering the earnings out here. So basically, these are the important points around the liquidity ratio and solvency ratios, more around the formula and the calculation and points to remember that I've discussed. Let's move ahead to see what is in store for us to help us with. Here comes the most important aspect. Till now, I have been saying that there are three important aspects of any ratios: calculation, interpretation, analysis with analysis, right? So for that, we need to have certain numbers, else the concept does not become clear for us. So let us do one thing. I'll move into an Excel where I try to help you out with these concepts that we have discussed till now around liquidity and solvency. So just give me 1 minute to quickly share the Excel. Yeah. Now I'll go to my Excel and I'll try to help you out. Yeah, I think we are into the Excel, and we are liquidity ratios in the liquidity ratios tab. So we'll first cover liquidity ratios and then we'll cover solvency ratios. So everyone, just focus upon on the left side first. Generally, in a question around ratio analysis, we are given a balance sheet. If it is a bigger question, and if it is a smaller question, we might be given piecemeal information, and that can be used for the purpose of calculating the ratios. Here, if you focus, what I've done is that I've written given in exam question. So this portion is something that will be provided to us, and better to compute is something that I've given is that generally as a student, if you are getting a bigger question, if you quickly do this type of calculation of, I'll say, the horizontal analysis that we were discussed in a comparative financial statement analysis, where we are seeing the change of the year 2 and year 1 and calculating the percentage. This may help us in doing the analysis based questions easier. Now we'll first focus on the computation part. Now if you go into the right side, we'll see that I have computed the current ratio, liquid ratio, cash ratio, and net working capital ratio using both the year 2 and year 1 number. And if we go one by one, the current ratio, we know current asset by current liabilities. If you just click on the year 2 particular cell for the current ratio, you'll see that we are taking total current assets divided by current liabilities. Similarly, for year 1, we have also computed. Then for liquid ratio, we know it's liquid assets divided by current liabilities, and my liquid assets is cash plus AR divided by the current liabilities. For both the 2 years, we have computed like that. For cash ratio, here we have taken the particular formula as cash plus marketable securities divided by current liability. But since marketable security is not there in our balance sheet, it is only the cash component divided by our current liability. Finally, for net working capital ratio, it is current asset minus current liability divided by the total assets. And the formula, as we know, we are deducting the current asset to current liability and dividing by the total assets. Now, this portion is easier, column K and L. If this comes in our question, we all, if we are knowing the formula, we'll be able to do it. But a challenge starts coming in when we are asked to interpret why a ratio has changed, increased, decreased, etc. And finally concluding about the position of the entity, maybe in terms of liquidity here, since we are understanding or explaining that concept. Now, if we look into the interpretation of why, how you should do it, let us try to see that. In a current ratio, if you see the year 2 and year 1, if we compare the year 2, the ratio has increased, and we know if our current ratio is higher, better is the situation, and that is why the comment here is better in year 2 than year 1. Next, in the liquid ratio, similarly, again, we find that year 2 has increased in comparison to year 1, so it is better. Similarly, for the cash ratio also, the percentages has increased, or in terms of what we can say, it is showing a better position than year 1. But interestingly, for the net working capital, you'll see that there is a negative. So the net working capital scenario is actually an alarming thing because it is having a negative working capital. So the business is not going to have sufficient cash to pay off their liabilities, because in our balance sheet we see here our current liabilities is 4044 and our current assets is 2717 for year 2, which is basically current assets less than the current liabilities. Now here another interesting thing that may come in is that a question might be asked that if we compare the current ratio or liquid ratio or cash ratio and see the increases happen in year 2, what has driven this particular change? Who is the key driver in the change? So if we see analyzing current ratio, our current assets has basically increased by 11.95% because the change is 290. Our current liabilities is also increased, but is marginal increase just of 0.60%. So basically our current asset increase has been substantially higher, which is driving our current ratio to be high in year 2. It is further asked in the question that what is that factor in the current assets which is driving this change. Then you have to analyze each of these components of current assets, and in that if you see the two components that is driving this big change is our cash and our inventory. So if the question has that option that which is the driver which is making our current ratio somewhere becoming higher in year 2 than year 1, and if you see the option it is cash or inventory, that would be the right answer. So this is the way how analysis has to be done. You first compare the 2 years to see how much change has happened. Then you see that which has increased, current asset or current liability. Then you see that which of the components within current assets and current liability has increased or decreased, remembering that the numerator and denominator concept relationship with the ratio. In the similar way, if you look into the liquid ratio, what are the drivers? We know that in case of the liquid ratio, acid test ratio, the liquid assets are our cash and accounts receivable. So naturally, cash is somewhere the component which is driving this big change. And in case of cash ratio also, the current liability has been having a very mere change of only 24 or 0.60%. The key change or impact has been made by cash. So this is the way you have to analyze each of the financial statement line item in the balance sheet or income statement to find out who is the key driver who is contributing to that change. And when you are interpreting it, please be careful that don't interpret on the basis of only one component. Take into consideration the impact of all the components. Now, another extension which might be from our question is that some analysis questions can be given. So I have just here put in two questions which has come in my mind, can be important for the exam. The first question, if my current assets increase and current liability decrease, what is the impact in my year two ratio? Now here they have not given the numbers. They have just told you in text manner that our current asset is increasing, current liability decreasing, how the change has to be made. In all these type of questions, remember my friends, don't look into the numbers in the balance sheet and quickly come to a decision. Please use hypothetical numbers. So here you have in the balance sheet current asset and current liability. They are saying current asset is increasing and current liability is decreasing. Just take some random numbers. Might be 1,000, you presume current liability is decreasing, and 3,000 is your current asset increasing. Add those two numbers to that of the existing balances in your balance sheet for the current asset and current liability, and see what has the change happened, whether the ratio has increased or decreased, and then select the appropriate answer in your exam. Don't go by the perspective that okay, current asset has increased, that means the numerator is increased, the ratio has increased. Okay, current liability has reduced, that means inverse impact will happen in the current ratio or in the ratio that is being asked to compute. Is always better that when numbers are not given, use hypothetical numbers to calculate and see what is the change or trend is happening, and then answer or respond. Then if the next question is what is the overall liquidity position of the company in year 2 and also vis-a-vis year 1. So interestingly, if you see that in all these scenarios that you have calculated above, our liquidity ratios have improved in year 2 compared to year 1. But one alarming feature is our net working capital being negative. So here we cannot conclude that the liquidity position of the company is very strong. There may be an answer option which is given in our question, but that would be misleading. So you should be careful in selecting the right answer option, because here, based on the calculations, we are seeing that though there is marginal improvement from year 1 to year 2 in terms of the ratios, but the net working capital is the negative. So our answer cannot be that we are having a strong liquidity position. So this would be a part of your analysis. And the text which is highlighted in red, very important, do not conclude your decision based on a single ratio. Compute other ratios also and observe the trend to conclude about the question that has been asked. So this is very important. No single ratio should be a determinator for your response. You should take into consideration a couple of ratios to compute and see the trend before concluding. Once you have understood the liquidity ratios, the same concept can be applied to any type of ratios for which the interpretation analysis asks. I'll also show you about the solvency ratios, how it is done the same way. Same balance sheet I have taken. The left side is something we will be providing in the exam. If it is a big question, better to compute the column F and G in order to find out the change that has happened in 2 years. Then coming into the aspect of year 2 and year 1, if it is a calculation based question, debt to equity, we know the formula, debt divided by equity. How we are calculating it, we know that total debt divided by total equity. So current liabilities plus the long term liabilities for year 2 divided by the shareholders equity. Similarly for year 1, the same way we have computed. If we go to debt to total assets, then how we are calculating it, total debt divided by total assets. So again, our current liabilities plus the long term liabilities divided by total assets, right? This is the again same way we have calculated for year 1 also. Then the long term debt divided by equity, or long-term debt to equity, that is a formula that is used. So in year 2, we are taking the long-term liabilities or long-term debt divided by our equity to compute for year 2. Same thing applied for year 1. So that is the calculation part. But now if we move into the interpretation, if it's a question is asked, the Y aspect, see for first debt to equity. What do we see? From year 1 to year 2, there has been a decrease. Now we have discussed that if our debt to equity ratio is lower, it basically indicates that the involvement of debt to my total finance is actually less, right? So financial leverage is lower, less riskier. So here we can say that both these two ratios are high, which is indicating a higher financial leverage and a risky venture, right? Because the debt compared to the owner's fund is very high. However, there has been a decrease in year 2 compared to year 1. Similarly, for debt to total assets, that is how much portion of my assets has been financed by debt, here there has been a here also we find that there has been a decrease. So basically in case of my debt to total assets, there is also an aspect of risk involved. Similarly, for my long-term debt to equity, here the year 2 and year 1, if we compare, the year 2 has become less than that of the year 1, but is again risky because a high proportion of our debt compared to the owner's fund. So this is basically the interpretation part, how it goes. If we ask further about our analysis, a question may come that if there is a fresh issue of equity shares, what will be the impact on the above ratios in Y2? Now, by seeing this question, apparently feel okay, equity shares increased, that means our denominator of total equity is increasing, that will be an inverse impact on my ratio. Okay, quickly we get answer. Don't go like that. It's better, again I'll say, use some hypothetical numbers, see how much your total equity becomes from what is given in the existing balance sheet, add that hypothetical number and see what is the impact happening in the ratio. This will help you to avoid mistakes in your exam. Coming to the next part, what is the overall solvency position of the company year 2 and also vis-a-vis year 1? So this particular question actually is a total cumulative response has to be obtained from all these three ratios. So our response would be, we are seeing that the financial leverage is quite high because the involvement of debt compared to the owner's fund is high, though there has been a decrease in compared to year 1 to year 2. But the solvency aspect is still in doubt. It is still in a risky situation because the company may fail to meet its obligation when it becomes due. So you have to select the right option. Don't go by the perspective that okay, there is a reduction in the debt to equity or long term to debt to equity compared to the year 1. So okay, fine, the company is going very well, but if you see the overall ratio, it is quite high. So you have to select the right option given in that exam so you can do the correct thing. That is very important. And finally, again, as I say, that do not conclude your decision based on a single ratio. Compute other ratios and see or observe the trend to come to a conclusion. Hope that this Excel has helped you to understand that how the concepts has to be applied beyond calculation into interpretation and analysis. Now let's quickly go back to our PPT to see what is basically there to conclude for us. So just give me quickly some time. I stop share this and go back to the perspective of our PPT. Okay, great. Coming back to the PPT, so I think we have understood now the concept of calculation, interpretation, analysis using the numbers. And the objective is that to help you how to extend your understanding into the different ratios and look out for more of updates from the Uplift platform relating to revision as pro videos, and this would be definitely helpful for your exams. So with that, I think I'll come to a conclusion of today's session. And if you have liked these videos, please share and look out for more such videos. Thank you.